We're going to talk about how we just broached $1 trillion in debt, but we're going to talk more about who's actually going into debt, who's actually becoming unemployed, who's actually having more pain in terms of their income, like which income demographic is getting smashed. First, we're going to react to a video that addresses some of these statistics. We'll add perspective to this. Then we'll get into what Bank of America discovered in terms of specifically who's actually suffering. We'll also look at American Express and Capital One to see what they have to say. So we have a lot of really good information to cover if you want more detailed information on what's actually going on with consumer debt and what we might be up against in terms of a consumer debt-led recession, a good old bubbly world. So let's listen in to this segment here from Breaking Points, and we'll react to some of the commentary they provide. Here we go.
Loan payments coming back into effect this fall could be a very dangerous state of affairs for a lot of Americans. Let's go ahead and put the numbers up on the screen from the New York Fed. They put up this helpful GIF on Twitter or X or whatever the hell it is now, showing the levels of debt. I mean, you can see that red swath there, that is student loan debt, 1.57 trillion. I mean, that is truly astonishing. You can see the credit card debt there. That's the orange, rising to $1 trillion. Auto loan debt, 1.58 trillion, and other at 0.53 trillion. So Americans really increasingly loaded up with debt and needing their...
And this, by the way, very true. The nominal levels of debt are absolutely rising. But there are some additional things to consider here before we get to the bearish part of where are people actually suffering, like which level, and that's not funny either, but it's like before we get to that, before we get to the painful part, let's talk about what this potentially actually means. And the first thing that we have to consider is a lot of people are talking about how student loan debt is going to crush the economy, that people are going to have this potentially average extra payment that they have to make of around $383 per month, and that could potentially reduce consumer spending by an aggregate total of 5%. What's really important to remember here is that Joe Biden's plan for student loan repayments has actually essentially extended people's ability to start repaying for about 1 year to roughly right before the election. Now, I find this really interesting because what you have is a student loan repayment regime, an obligation to repay that starts here shortly in about a month. But if you don't make your payment, they'll just add your interest to the back of the loan for the next 12 months. And they won't report you as delinquent to any kind of credit bureaus or add any late fees. So basically, for no additional fees, you essentially have your student loan as a line of credit that you don't have to start repaying for another year. I personally think that is going to buffer how much of an impact we actually get from the student loan disaster, because I think people will start repaying at different places, right? It's not like all of a sudden, September rolls around, everybody has to start repaying, you get that instant hit. Some people start repaying in September. Some will start repaying after the holidays, like January. Some will think that they can start repaying in January, but then don't start repaying until March or April or May or, next year when they actually start having to make those payments. That's really important. Now, the next thing to consider so first of all, you're going to have sort of that tapered response. The next thing to consider, which is pretty remarkable, is that right now, household debt service payments as a percentage of disposable income are very low relative to historical standards. We're sitting at right about 9.6%. So if you have $100 left to spend on whatever you want, only $9.60 are going to debt right now. Before the 2008 crash, we were at about $13 out of every 100 going to debt payments. Before the early 90s pain, and even in the late 80s and the S&L crisis, we were at $11 to $12. Before the dot-com bubble burst, we were at $12. Really, right leading up to the pandemic, we were close to 10 to 9.8. Now we're sitting at 9.6. So we're relatively at a lower level for a percentage of debt payments that are being made, despite the fact that debt is nominally higher. Nominally means not inflation adjusted. If we actually inflation adjusted how much higher debt levels are now, total credit card debt levels, if we actually inflation adjusted those now, you'd have to actually take off another 18% to get back to February of 2020 levels, which is pretty crazy because if we look at 2020 levels and we pull off 18%, we would actually have lower inflation adjusted debt now than we did in the pandemic. Look at this chart. Right here on screen, you're going to see that right now we just broached $1 trillion. This lending tree chart hasn't updated with the latest info that just came out in the last couple of days. We just broke $1 trillion. Okay, fine. But if you take 18% inflation off of this, you'd actually be inflation adjusted at about $820 billion. $820 billion puts you right about here, which is closer to the peak that we saw in '07, but not the peak that we saw before the pandemic, which is pretty remarkable. So inflation adjusted, we're actually lower than where we were before the pandemic. Kind of crazy. And this is the problem with nominal analysis of numbers. Like, oh, it sounds big and bad to say, oh, $1 trillion in debt, that's bad, right? It sounds bad. And, it makes for good videos. But there is actually an underlying problem. And I want to remind you, we've got to talk about that underlying problem because there is an underlying problem. Before we do that, we're going to listen to one more part from the Crystal and Seeger part here. We're going to go to 7:35 in this video. We're going to look at some of these stats they report from Yahoo Finance, and then we'll get into some of the credit card actual bad news here. Now, I quickly want to remind you that if you're looking for a licensed financial advisor, we're now offering financial advisory consults. Get stacked with StackHack by going to stackhack.com. It's myself and the team. You'll actually get me looking at your actual situation, your financial situation, coming up with a wealth plan for you or your portfolio or your favorite stock or whatever. Learn more at stackhack.com. It's actual financial advice. It's actually nice to be able to really say that now. Yes, we can really offer financial advice now. So I'm very excited about that. Learn more again at stackhack.com. Okay, so what do we have here? Let's get this data.
Have had credit card debt stretching back decades to before 2006. And to me, the most disturbing indicator here, they say 49% of Americans, so very close to a majority of Americans, actually depend on credit cards now to cover essential living expenses. Those numbers are even higher for young people. Gen Z, 61% of Zoomers rely on credit cards just to be able to pay their normal living expenses. 53% of millennials, on the other hand, boomers, in a very different category, only 20%, 26% of boomers rely on credit cards to cover essential expenses. So, Sagar, this fits with a lot of what we've been reporting at this point for years.
Mm-hmm. So on this data, it's really interesting. They argue that it's Gen Z and millennials who are relying on credit cards more. But is that actually the cohort that is really relying on credit cards more, or are they just using credit cards more? Is there a different metric that's actually going to show us who is suffering the most? And the answer to that, obviously, since we're talking about it, is yes. First, to understand a little bit more though, it's worth looking into the earnings sheets that I have from Capital One and from American Express. So let's take a peek at some of the notes that we get from these. So if we jump on over to American Express, take a look at this. Millennial and Gen Z customers continue to be the fastest growing portion of our card member base, with billings up 21% year over year in the quarter. Of particular note, our international card business was the fastest growing segment for several years, and it is again the fastest growing segment. And this is being driven by strong travel and entertainment spending, which is really associated with Gen Z and millennials. A lot more of that travel spending. There was a report in the Wall Street Journal this morning that millennials and Gen Zs are basically flying around the world to follow Taylor Swift around and causing traffic pattern delays and screwing everything up. They're blaming T-Swizzle again. Love T-Swizzle. But anyway, We also saw continued strong demand for our premium products, with over 70% of new accounts we acquired on fee-based products, and 60% of new accounts acquired globally coming from millennials and Gen Z. So it's true, more travel spending and Gen Z and millennial is getting more cards. But does that mean they're the ones suffering? No, not necessarily. We'll get some more detail here. A little bit more from American Express. Gen Z millennial spending is growing. It's not the boomer sector that's spending more money. It's actually, and we expect this to continue to pick up as the economy gets better. What's actually getting hit based on American Express is the small business sector, which the small business sector and the entrepreneur sector is going to give you a little bit of a heads up as to where the pain is coming. You're going to get more details from Bank of America in just a moment. But first, let's drive up over here, going to Capital One. Capital One usually has lower credit score customers, and they do indicate that they're starting to see defaults and charge-offs trend back to COVID level, like pre-COVID levels. That they're still below pre-COVID levels, but we're kind of trending back to that. And the Capital One customer has actually seen relatively flat spending. Capital One customers usually a lower credit score than your more premium American Express customer. Okay, great. So now, what does the Bank of America reveal on who's actually getting punished here? Because remember, we keep hearing millennials and Gen Z getting more cards and spending more money, especially the higher credit score ones, compared to the Capital One ones. And we heard from Crystal and Seeger that, millennials are, taking on potentially more debt, increasingly relying on the credit cards. But are they actually relying on the credit cards? Well, here's Bank of America. Bank of America right here says that lower and middle income households remain resilient. Oh, this is interesting. So now we're talking about income. Think about what we've talked about, all these different things for a moment. We've talked about generations. Then we talked about entrepreneurs and biz owners, right? Then we talked about credit score, the lower credit score, spending flat. Younger generation, spending up. But now we're going to talk about the most important one, and that's the income demographics. So based on incomes, what's going on? Well, based on incomes, lower and middle income households remain resilient. However, higher income households still appear to be under some pressure from slower wage growth and incrementally weaker labor markets. The trough of goods spending might now be behind us as we've moved from goods to services spending and that rotation. And now we're kind of returning to pre-pandemic spend levels. So in other words, we might see this flattening of overall spend and then an increase in spend again as we kind of normalize and go back to pre-COVID trends. But look at this, folks. Different income groups are experiencing different results. Lower and middle income households remain fairly resilient. Higher income households feeling the pinch. In addition, higher income consumers experiencing a faster rise in unemployment and a bigger drop in wage growth. Have these trends continued in July? Our Bank of America data says yes. Look at this, folks. Here's a chart. After-tax wages and salaries growth by income group. The over $125,000 income group is actually negative. Well, you were negative here for a moment. You're barely positive. So you actually went negative on wages for the over $125,000 income group. At the same point, or same token, you actually see the number of households receiving unemployment benefits elevated for the $125,000 income group. So the $125,000 income group sees elevated unemployment benefits with a 60 to 70% increase in unemployment benefits. The 50 to 125K segment seeing about a 40% increase in unemployment benefits. And the under $50,000 cohort only seeing about a 25% increase in unemployment benefits. Now, this is kind of remarkable because it's the opposite of what you would think. Draw this out for a moment. So we can sort of reconcile this correctly. So what I like to do is I like to just draw a T-chart. And what we're going to say here is who's doing worse and then who's doing better, right? Because this is going to potentially help us understand potentially where to invest. And so who's doing worse? Higher income is doing worse. Who's doing better? Lower and mid income. That's the opposite of what you would expect, right? Who's doing worse? Lower credit scores. That's your Capital One, right? Who's doing better? Your American Express. Higher credit scores. Who's doing better? Employees or entrepreneurs? Employees are doing better. Who's doing worse? Entrepreneurs are doing worse, and small biz are doing worse. Who's doing better? Gen Z and millennials are doing better. Who's doing worse? Well, in many regard, older segments, like potentially, not bloomers, boomers, there we go. The reason for this, by the way, could be because of stock market sentiment over the last year. So I like personally, I would take a screenshot of this if I were you. I think it's a good distillation. Here, I'll freeze for a moment. There you go. I take a screenshot of that because I think it's relatively consistent with what we're seeing in the actual data. There was a sentiment chart here somewhere. Yeah. See, look at this. The higher income threshold saw the biggest drop in sentiment. The lower income tier didn't see as much of a sentiment decline. A lot of that probably driven by the stock market. That's my opinion. So that's something to pay attention to. Higher income households feeling a little more cautious, says Bank of America. Now, this is surprising to me because, again, we hear this idea of, oh my gosh, there's so much credit card debt. Okay, that implies that it's lower income consumers or lower credit customers who are suffering and they're having to spend more on credit cards. When the potential reality is it's actually your white collar group who's potentially having to spend more money on credit cards. And maybe that's why the nominal levels of credit are higher, because they have, larger incomes but larger expenses. Somewhat surprising. It doesn't take away from the fact that we're probably walking into a big credit bubble. I mean, consider that you also now have to factor in buy now, pay later and personal loans as an expansion of credit. Buy now, pay later, a much more recent innovation, dare I say. But I mean, now you go to checkout on Amazon. I was just ordering something on Amazon yesterday. It was actually a bundle of things. It was going to be like $1,097. And I'm like, quickly processing through the checkout and putting my little PO number. And then I'm like, all right, checkout. And so I go to checkout, and in the checkout window, I'm like, all right, just pay with the Amazon card like I always do, because you get, 5%. Well, I go to hit checkout, and then they kind of moved the checkout button down a little bit from where I was used to it being, because now they put a little bubble up, and it's like, don't want to pay $1,095 now? Why don't you pay $93 a month for the next, X months or whatever it was? And I'm like, yeah, I don't know if that's a long-term good thing. It makes me a little nervous that we could be creating a longer-term debt bubble cycle, and I personally recommend people stay away from buy now, pay later. A lot of people use it just to manage cash flow, and I understand that. I'm not the biggest fan, though, of taking on consumer-style debt. Obviously, if you have some sort of extreme business purpose for something and you're willing to take on that risk, there's an argument for debt, but with any debt comes risk. So that's always something to consider. Real estate debt, though, obviously, I rank at the lowest level of risk, especially if your rent covers your mortgage. Anywho, those are my thoughts on this trillion-dollar debt bubble cycle. Yes, in the longer term, the debt bubble will probably be an issue, but here in the shorter term, it's actually surprising to see that's the higher income demos, those entrepreneurs that are getting a little bit punished a little bit harder. Not just entrepreneurs, obviously. You have a lot of higher income salaries as well, whether it's in finance or otherwise. So now, I want you to know this: when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.